Hello, welcome to the first episode of a new series I'm doing called Firm Returns Weekly. So I've just started a new newsletter due to popular demand. And this is going to be just a quick summary of some events that have happened with companies that are in my portfolio. So things like this was we'll get onto this week. It'll be release of a game from tinyBuild, for instance, or some other earning event from a company, or we've had like a movie release from Warner Bros. Discovery to mention as well. So we're going to go through some of these kind of things. Also, just sort of any other general news. So appearances, perhaps if I've been on other podcasts, or if some other project I'm working on. So yeah, we'll get on to something else that I've started working on at the end of the episode. But yeah, let's I'll just so yeah, this will be a video series here, and then also do an audio version, audio only version, which I'll put out as a podcast. So let me just share my screen here. Here we are. So yeah, this is the first edition. As you can see here, it'll all be under the weekly updates tab, and then it'll go out as a separate newsletter if you do subscribe as well. And with that as well, I just want to make a point that these sort of three separate pages I've got here, each one you can actually independently subscribe or unsubscribe to in your account settings. So you just go here. I'm not signed in here, but if you were to be signed in, you can go in and you just literally one little tick box to opt in or opt out of these ones. Everyone's been automatically enrolled into that's currently subscribed into the weekly updates one. But yeah, if you decide you don't want this and you just want to get the stock analysis, you can just choose to subscribe to this or the portfolio updates and opt out of this new one. So just so that people know. Right, so let's get going. So again, it's going to be pretty short compared to the normal podcast. I'm just going to quickly go through one of these few news items. So first of all, we had the release of Punch Club 2 Fast Forward from tinyBuild. So I've said here, the game got off to a great start after its release on the 20th of July, appearing at the top of the trending games list on Steam for much of the first week and spending several days in the top 40 bestsellers on the platform. I think I at least saw it in like 36th place or maybe higher in the first few days, but I didn't get a screenshot then, unfortunately. I think I got one when it was on the 40th, but which was like a four or so days after the release. But yeah, you can see here in this picture right at the top of the list with a good number of concurrent players. So the peak player count was 5,509 on the 22nd of July. And since then, it's held up reasonably well, with daily peaks consistently above 2,000. So you can see here, got a nice peak up here of 5,509. And it held up pretty well over the weekend, and now coming down. We'll have to see. I mean, I don't know whether I'll have to have a quick look at this graph again. It might be that we've gone back up again. It was sort of like a trend down because of the going through the midweek, and there might be another rise as we get into the weekend. But yeah, it's still holding up really well. I mean, and compared to a lot of other games, it's to still be above 2,000. So on is great, and that early peak is particularly impressive. So follower numbers have grown rapidly since release and are now in excess of 11,000. So yeah, we can see this is a follower chart. So it's kind of around about, I want to say 6,000 or something just before the release, and now it's heading up and it's pretty close to 12,000 actually. It might do it in the next few days. So yeah, we've had almost a doubling of the follower numbers, which is good, and just hope that keeps tracking upwards. And then finally, the game currently has 1,025 reviews, of which 79.9% are positive, which I think qualifies it to be classified or shown as it's certainly shown as very positive on Steam, which is good. It should also be noted that the game released simultaneously on PC, Xbox, PlayStation, and Switch. So the numbers we've referenced above will only represent a portion of the overall picture. Right, so moving on. Something else I found quite interesting this week was a post-mortem of Hello Neighbor 2, presented by Alex Nishi-Porshik, the company's CEO, at the DevGam conference in Vilnius, Lithuania. It gives you a real insight into the Hello Neighbor franchise and the challenges faced in developing Hello Neighbor 2 that ultimately contributed to its lackluster performance. So I've got the video embedded here, so you can have a look at that. It's over on YouTube, on the DevGam YouTube channel. Yeah, it's quite a good one. I did learn quite a bit about the infrastructure they've kind of built up around. They had to get in place to really expand after the initial success of the first game. They really just expanded out and got a lot of different things in the works, but they had to build up quite a substantial team to do it, and then were hit by a lot of issues as you went into the pandemic, and then also some of the teams working on the game were caught up, were impacted by the Ukraine or sort of Russia conflict and had to be relocated and so on. So yeah, it ended up being they had to kind of roll back expectations a little bit. It is the sort of brief summary. They put out an initial trailer for a game, and then the really excited fans, and then it ended up having to be rolled back a little bit, the ambitions of it, and the game that came out finally was a quite different game to what was advertised in the trailer. So yeah, it was it's unfortunate, but I think there were some key takeaways, and it still gave. I mean, the good thing was that it was technically perfect in terms of the release went very smoothly. There wasn't really any bugs or anything like that to deal with. It was technically, and it went across all platforms. So that was the proof. It was literally just the game mechanics which they had to roll back a bit, and they had some interesting, some challenging things as well. Like they had to make a choice about the initial game concept they were going for would have been very computationally intensive, and so because they were thinking they wanted to put the game out onto less powerful devices like iPads and iPhones or whatever, iOS operating systems, they had to take that into account, and they were thinking they had to make a choice. Do we want to have effectively cut out a key audience for the game for some of these consoles and stuff like that, and it potentially wouldn't have worked on the Switch as well? Or do we want to cut out some of our key audience, or do we want to wind back some of the computational requirements of the game a little, make it a little less ambitious? So I think it was because they were having the original concept. Like I say, I recommend watching the video, but the original concept was to have like an AI that followed you around a more sort of open world map and was sort of stalking you, and that kind of having the AI learning and stuff like that and following you around wherever you go was going to be quite challenging computationally. So yeah, it's going to require quite a lot of power to do that, which was going to become a problem for some of the things. But yeah, it was I mean, I really quite like the look of the initial alpha release trailer they put out. It did look quite scary and quite good. So, and then like I say, the final game wasn't anything like that. So I can see why the fans were throwing a little bit and felt a little bit hard done by. But anyway, yeah, very interesting talks, and it just gives you a good idea of just generally the whole infrastructure that's been built up, the development, porting, everything like that that's all been put in place to support that franchise and can be deployed to other franchises and so on. But yeah, it's quite interesting just from a business point of view as well. So yeah, next on tinyBuild, we had we're going to mention a little bit something about IM Future. So last weekend, I participated in a playtest for IM Future prior to its release in early access on the 8th of August. I can't disclose any details about the game at this point, but I can say it was very polished and kept me thoroughly entertained for the 3 or 4 hours I had before, the 3 or 4 hours I had to play it. So after playing it, I was not surprised to learn that it had been developed by one of the original creators of Graveyard Keeper, a hit success within the genre that still has daily player counts in excess of 2,000, 5 years after its release. This is Steam, of course. So overall, things are looking promising for a strong launch. So yeah, it did look quite promising from when I played of it. Like I said, I can't disclose anything more, but yeah, very encouraging, very high quality game, very polished. So yeah, right. Finally, on tinyBuild, I wanted to mention that the share price movement we've seen since the release of my write-up on the 18th. So the price has risen around about 40% to 13.75 pence. And the shares are still incredibly cheap and a long way from their price just 2 months ago. But the recent share price growth does demonstrate that the impact of illiquidity on price works both ways. So yeah, I've got a graph here just showing you the percent taken from the London Stock Exchange website, showing you just the percentage change over the last couple of weeks, and then the percentage change over the last couple of months. So you can see it's still very dramatically down, something like 75% down over 2 months, but it's 40% up over 2 weeks. So yeah, we're making some inroads, but still plenty of margin there to be plenty of discount to be buying it now, and I quite likely will add something in future. I'm just in the process of rebuilding my cash reserves after diving in and sourcing some cash to get it at when it dropped right down here after I think I got it around about 8 pence a share or something like that was the price I was able to buy it at, and then I bought more when it was around about 10 pence. So yeah, it's still very happy to buy at this price. Right, so moving on to Warner Bros. Discovery. We'll start off by looking at some news on the strikes. So strikes are becoming an increasingly impactful. Strikes are becoming increasingly impactful, with production of many new projects being halted due to the Actors Union now voting to join the Writers Guild in strike action. And then I've given here a link to an article that I found particularly informative. So let's just have a quick look, see if we can see. Oh, didn't really want to do that. Yeah, so there's an article in the Telegraph that was quite good, going into all the details of it and talking about the different sort of guild writers, the actors, so on, which gives you a lot of details about different films that have been impacted. One that I was quite concerned about as a film viewer was that the sequel to The Gladiator is being filmed in Cyprus right now, I think, and that production on that is completely halted, which is pretty sad news. Hopefully that's still, because we haven't got Ridley Scott's getting pretty old now. It'd be not that much more time for him to get that sequel out. But yeah, so it's certainly having a wide and far-reaching impact, and now with the actors going on strike as well, it basically makes production impossible. So where before perhaps they would have, with the writers on strike, they would have kept on going with some films, and just UN ended up having some movies that had questionable plot elements and stuff because there weren't really any writers working on it once it started production. We're now in a situation where there's not even any actors. So yeah, filming is having to completely cease on these ones. But yeah, some things were, one small positive I saw was I think didn't impact the, I don't think the acting sort of strikes impact some of the British actors. So because House of the Dragon is being filmed in the UK, I think it mainly in Northern Ireland, because it's being filmed there, it's effectively, it seems to be that they're able to continue production on the second season of that. So that's a small silver lining for but I think an impact that was highlighted in the article was that we're going to see a lot more reality TV and unscripted stuff coming out, because yeah, the scripted stuff is certainly being heavily disrupted with all the actors and what have you. So expect a lot more reality TV to be coming onto your streaming services in the next year or so. Right, so next we have Barbie. So Barbie had an excellent opening weekend and is looking like one of the biggest releases this year. You can see from the chart below that it is currently on a steeper sales trajectory than the Super Mario Brothers movie, which is the most successful release of the year so far. So yeah, you can see I've got a few different references here. So I've got the Super Mario Brothers movie, which this is showing daily cumulative domestic box office sales. So Super Mario Brothers comfortably going above, getting, yeah, it sort of did about 500 and, let's have a look, it might have there. Yeah, it did 574 million in domestic box office. So that's just the US box office in total. And it Barbie is actually on a steeper trajectory than it was currently. So I have to see how it does after this second weekend, if it still can keep the trajectory going. But yeah, we looks like we could be looking at a similar kind of number, maybe 500 million plus, just from the US sales. And then, I mean, worldwide box office for Super Mario Brothers, we got was 1.355 billion. So yeah, really smash hit, and it looks like it's similar budget for the production. I think Barbie's had a lot of marketing spend though, so it certainly has felt like it. So perhaps the overall spend was a bit more, but quite an interesting thing actually to look at is the performance. So you've got Guardians of the Galaxy Volume 3 and Spider-Man Across the Spider-Verse both came out this year as well. They had a really good initial run, but still not as steep as Barbie movie, and they actually started to drop off quite a bit earlier. Neither of them managed to get over the 400 million mark, and was quite, well, yeah, it's looking like they won't. Spider-Man Across the Spider-Verse is not quite there, but it's a bit higher. But yeah, they didn't do anywhere near as well as Super Mario Brothers movie did overall. In the end, started off similarly well, but then kind of tapered off pretty hard. But the really quite shocking one to me actually was when you look at Mission Impossible: Dead Reckoning Part 1, and that is really done nowhere near as good. The launch trajectory has been high, but what's kind of interesting is that actually had the largest budget of all of these movies here, a $290 million production budget. And in its opening weekend, just to give a comparison here, it only did $54.7 million in revenue in that, in sales in that first opening weekend in the US. And when you put that into perspective, you've got Barbie, which had, again, a production budget of about 100 million, and in its opening weekend in the US, it did 162 million. And comparatively, we've got Super Mario Brothers did 146.4, Spider-Man did 120.7, and Guardians of the Galaxy did 118.4. So yeah, you can just see it's that Mission Impossible is like a third of Barbie pretty much, and about less than half of the other movies we've referenced. So yeah, it's quite interesting that I really was a bit shocked. I thought that was going to be a much bigger hit. Having said that, the international box office has been very good for that one. So even though it hasn't done as well in the US, worldwide it's now 380 million. So yes, it was like it's a week ahead of Barbie. But Barbie's on 452.2 million international after basically a week of being out, and after 2 weeks of being out, it's still nowhere near as good. But yeah, it just shows you that it does seem to be a much larger share is coming from the international box office, which kind of makes sense because I mean I believe it was filmed in lots of European locations and stuff like that, for instance. So could widen its appeal. Yeah, still quite shocking that how low the interest was for that film in the US. Yeah, really quite surprising, especially when you think about how crazy well Top Gun did. It was like it shot the lights out. I think it did pretty close to a billion just in the US. That's all the national pride stuff for the US. Anyway, right, so that rounds off the Warner Brothers Discovery. So we move on to Fuller Smith and Turner. So Fuller's announced on the 21st of July that they will be commencing a share buyback program for up to 1 million shares in an effort to close the gap between the share price and underlying value. From a capital allocation standpoint, it's the most rational course of action, since the alternative would be to use the cash to purchase new properties and a market price effectively double that of the company's existing properties. So yeah, that's it's been quite a positive mark in management's favor. I didn't actually get to attend the AGM for this one because it clashed with something else, but it would have been it's a question I would have brought up at the AGM, and it turns out they basically did exactly what I was going to propose anyway. So it's good, and it could. I mean, at the current share price, this is going to work out to be, if they did buy back 1 million shares, it'd be about a roughly £6 million return effectively to shareholders. But they're only, because of the liquidity in the stock, it's pretty crazy. They're only able to buy like 10 to 20,000 shares a day, because I think they're limited to doing about a quarter of the volume of the daily volume. So just from the rules of share buyback programs. So I guess we haven't seen a great deal of movement in the first week, I guess, but I mean, there was also share option issuance or something like that around a similar occurred in the last week as well. So I don't know whether, but I doubt those are going to be immediately sold. Maybe, who knows? But oh well, that would have been disclosed if they had been, but so I don't think they have been. But yeah, in terms of just liquidity, I guess there's still a bit of slack in there at the moment, even though it doesn't trade many shares each day. So yeah, it's as that starts to dry up and we start to lose sellers, the pool of sellers for the shares starts to decrease, we'll start to see some share price appreciation. I mean, it's going to take them a fair few weeks to complete the buyback program of just 1 million shares if they are doing it sort of 10-20,000 a day. So yeah, could be interesting. But I think yeah, the point I was trying to make was, if we do start to get the share price going up as they're buying them back, which I guess is their intention, then either they'll spend more or they'll hit their budgeted amount and buy back less shares. So they didn't disclose exactly what the budgeted amount was, but yeah, maybe the share price goes up enough, they'll stop buying, because they'll have said, right, that's all we were planning to spend. Anything else to say? Yeah, so I mean, the share price has actually gone up quite a bit since I did my initial write-up for the Smith & Turner as well. I think it's up about 20%. Maybe not quite 20%. It's about 20% from my average price, but I think it went down initially, so I did average down a bit. But it's close to, it's around about £6 a share now. And I did a write-up, I think it was £5.14 or something. So yeah, it's still appreciated quite nicely. And yeah, hopefully this share, and we've had a dividend and so on as well. Hopefully the share buyback program will help to close that gap a little bit more. So next we've got, I mean, it's been a pretty busy week for updates from companies, as you might expect with it being sort of earnings season and stuff, but there's a few other I mean, some of these things are completely unrelated to earnings releases, so they're just quite a busy week across the portfolio for news. So next we've got some news from Ecora Resources. So Ecora Resources announced on 24th of July that it has acquired a 0.25% net smelter return, or NSR, royalty over the Vizcachitas copper project in Chile for a total cash consideration of $20 million. The mine life is estimated to be a minimum of 26 years, with considerable potential for extension, and production is expected to commence in 2029. And they have some sort of contingencies in place as well, where the rate they are able to charge, or the percentage goes up by like 0.05 or 0.1% for like every year after every year of delay or something like that, or they have to be paid either that happens or they get paid back like $5 or $10 million for each year or something like that. So they basically will get there's contingencies in place to de-risk it a bit. So if the project is delayed or doesn't go ahead as planned, they'll get the money back, or they'll get increased future returns. It's a bit like they had for I'm trying to think. I can't remember that, but they're possibly Mantos Blancos, or maybe I might be getting wrong. But anyway, the copper nickel mine they have in I think also, no, I think that was Brazil potentially. Yeah, but anyway, that particular project, they have similar contingencies in place and I think they now are getting a higher percentage rate because it was delayed by a certain percentage, but I might be misremembering which one it is. But yeah, there's plenty of, they have examples of this and that. But as far as I understand as well, this is a direct first party primary transaction. So they're directly giving the money to the operator of the mine, they're not buying an existing royalty off someone else. So yeah, it just shows the company does have a real mix of these kind of relationships. One thing that was also quite interesting is I believe the people who set up the funding for this was RBC, Royal Bank of Canada, and I know that there's some members of the board of possibly even the chairman, I think, of Ecora Resources that have a past of working for RBC, and I think, yeah, either working for them or working with them or something like that. But I think it was working for them for quite a number of years. So yeah, that's obviously demonstrating the value of some of the board members here to have helped set up this deal. But yeah, I've just then given a rough estimate of potentially what this royalty could translate to. So as a rough estimate, using the current copper price and estimated average annual copper production of 153 kilotons, the royalty would generate approximately $3 million for Ecora annually. this alone would be a good return over 26 years. Yeah, I mean, it'd be a pretty tidy multiple of the original investment, but it could be much higher if copper prices rise as anticipated. So yeah, good news from Ecora there that they're able to continue deploying capital, and there's also that other 70 million that they're potentially going to be able to do in that copper nickel project that I've just mentioned before. So we've next got Taylor Maritime Investments. So on the 27th of July, TMI released its annual report for the year ended 31st of March 2023, and then a day later, its Q1 trading update. So yeah, I'm not going to go into any details about that now, but I had a quick look through them both, and yeah, it's increasing complexity, and I do need to do quite a bit of work on this to re-underwrite my position, I think. And I've said as much as I've said, this is certainly a company I need to do some more work on, as it has become increasingly complex post the Grindrod acquisition. I'm also considering traveling to Guernsey, which is where the company is headquartered, to attend the AGM, as from a brief look through the annual report, I think I'll have plenty of questions. In any case, you can expect a new write-up from me on the company soon. So yeah, I mean, the shipping market generally has been a bit depressed. Their rates seem to be holding up above that, but they're still come down quite a bit. They're focusing on deleveraging the company after taking on a load of debt to do the Grindrod acquisition. Some of that's happening by them selling ships in the fleet, and then other parts of it is they're transferring. They're doing. I think they've changed the capital rules for the capital structure for Grindrod, and they're going to release some of the capital from the company to pass back to all shareholders. But TMI now owns, I think, 86% or 87% of the company, so pretty much most of it is coming back to them, and they'll be taking that cash back to pay down the debt that's sitting on TMI's balance sheet. But it's all quite complex because everything, all the earnings you see in TMI are all just dividends, because all of the assets, all of the debts, everything are all held in subsidiary companies. Each ship in the fleet has its own SPV, which I think is a special purpose vehicle, which basically just means that the liabilities are there. I don't know what kind of look through basis they have, but it means they basically don't pay any tax, because all these boats that are individual companies, as I was saying, like SPVs, that are all registered in Panama and other sort of tax havens. And so it means that, and then obviously Guernsey is a very low tax area as well for the parent company. So yeah, you're basically not, the company doesn't really have to worry about tax, let's put it that way. But yeah, it does complicate things, and it means I want to really have a dig in and try and this is, given the company who's only been around for a couple of years now, this is probably the first annual report where you're really going to get a lot of detail about kind of what the operation looked like. The first year's results were really skewed by the fact that they were just deploying the IPO proceeds and acquiring a fleet of ships, which then almost immediately appreciated in value because they were buying them at a given price, and the value went up quite a bit. The value has actually come down a little bit now, so I think it was 100. So in the Q1 trading update, they reported that previously, at the time of the annual report, I think it was like 170 or 172. Sorry, 1.72 or $1.7 per share. It's now come down a bit to $1.56. But the shares are still trading below $1 a share, so it's still a massive discount. But yeah, it's coming down a little bit. Things are softening. I think the yield, because of the daily rate coming down, the yield's gone from like just in at the time of the annual report, it was like 17.5% gross cash yield on the fleet, down to now some like 7.5%. So just showing that operational leverage there coming into play as the rates have fallen. But they've locked in some longer term rates that are at a pretty positive price, and the debt is being paid down by them still being able to sell assets. But the thing I really want to just get to real grips with is just thinking, just not so much worried about the concept of the fleet value going up or whatever, which is how they've had a lot of the gains from last year. Though, I mean, the operations charter rates were crazy high for quite a bit, I think, of 2021. So they did get a real massive, I mean, it was like crazy yield at one point, like 35% or something yield on the fleet. But yeah, I want to know really how they're planning to, what the picture is going to look like for them increasing the cash flow from operations, the actual the dividends effectively they're getting paid, because that's the format it comes in. For the dividends they're getting paid from the fleet, that's the real cash that can then be distributed to shareholders, and they have to pay out quite a big percentage of the cash that they generate from operations, just because of their investment trust sort of structure. That means they have to pay it's kind of like a pass-through regulation for it, so they have to pay out a lot of the stuff they're going, which is why they were able to, I mean, the yield when they did have their boon, let's say, so they originally were on 7 cents a share was the payout when they first IPO'd. That would have been a 7% yield, and then paid quarterly, split into 4, paid quarterly. Now then they raised it to 8 cents a share, so an 8% yield of that, but but like I say, below $1 a share now. And then you've got when they did they did a special dividend as well, and it worked out being something like 11.5 or 11.3 cents a share. So you're getting like 11+% yield on the shares, which is pretty great. And now, like I say, the dividend is now, they're pretty comfortable with the 8 cents a share level. So you're still getting, that's a pretty stable return you're getting there. And then I think, but yeah, I would just want to know how they're from this point. Is it just a case of them paying down the debt, and then automatically they're going to get a bigger, they're not paying debt interest anymore, so they've got more operating cash flow from there? What are they going to be doing to continue to grow that operating cash flow? Yeah, that's kind of the stuff I want to have a look at, and potentially I'm going to, if I went to the AGM, I think but there's a lot to delve into, like I say, because of the complexities of the corporate structure and so on. So I'm sure I'll have plenty of questions if I do decide to go. But yeah, so I then just wanted to mention that last weekend I made an appearance on the Punch Card Investing podcast, with Jack Duffley hosting it. And then the topic we discussed was how to evaluate management. So yeah, I think it's a pretty good discussion. I certainly had a good time on there. We sort of, the topic was, like I say, management. I came with a whole list of different talking points. Whether that shows up. Not really focusing. All right. Yeah, I came along with a whole list of talking points for it, and about various sort of topics. So what we were talking about, alignment with shareholders, how we evaluate performance, relationships to stakeholders, also, yeah, a big range of topics. And it was kind of good because I think we were able to tie it into a lot of examples of different companies. I referenced companies I own in my portfolio and stuff like that, and past companies, and we'd referenced some other sort of big names and so on. So yeah, it was an interesting one, and I think quite a few sort of case study examples in there and stuff like that as well. So yeah, give that a look if that sounds of interest. Yeah, and then finally, I wanted to mention an exercise I'm currently undertaking to source new ideas. So I filtered down all the companies in the London Stock Exchange to leave just those with a market capitalization between 20 million and $1 billion, which equates to roughly 650 companies. That's also stripping out all the, funds and what have you that are still listed on, and trusts and so on, that just listed on the market. So anything that was like the industry was capital markets or something, I basically excluded those, which still leaves like real estate investment trusts and things like that. So it's not fully stripping out everything, but yeah, I've started working through them one by one to create a short list of ideas for future study. So yeah, I'm just basically going through them all one at a time, and some of them you can just quickly say, oh well, that's crazy overvalued, or that one's really doesn't look great. It's had just declining revenues for years, and it's loads of debt or whatever kind of stuff. You can often just exclude them fairly quickly. But some of them have been some quite interesting ideas just already. I mean, I've done about I think I've been through about 15 the first quick session I did of an hour or so. And I picked out 4 that were quite interesting. Something that I kind of like to see is situations where it's cheap, or it looks cheap, but there's some complexity, and often the complexity is what's causing it to be cheap, rather than there being some other real fundamental issue with the business. It's just a case of it's kind of too hard. It takes a lot of work to get you. There's a lot of uncertainty because of the complexity introduced. But if you can actually try and delve into it and put the work in and understand it, you can actually get to a position where the uncertainty for you, from your perspective, decreases significantly, as kind of been the case with a lot of the companies I'm actually invested in. Like Warner Brothers Discovery is an example there. Lots of uncertainty just looking at a quick glance from the outside, and most people sort of see it. They look at the debt or what have you, kind of stuff. And then having put in some work, I was kind of able to reach a point where the uncertainty decreased enough to create a real margin between what I think the real value is and the share price. And yeah, so my plan is to as a little segment at the bottom of the article each week, or in these videos, is to sort of just mention any that have pulled out in the last week that have been looked like a potentially interesting enough to be put on the shortlist. So the first one was Volution Group PLC, ticker FAN. So I said it was a little too expensive from a first glance, but it was profitable and growing, so it could be worth a look. I think I had a pretty good growth curve on there, which is why it was perhaps a little bit expensive. But that's what I was saying, you'd need to have a little bit more work to try and determine what's the growth going to look like, and maybe that's still fair price. Then we had Reddy Northgate PLC, REDD. So this was cheap, but it had a fair amount of debt and some other complications. So potentially another one where you could delve into a little bit and find the hidden value there. And then you've got the next I saw was Conduit Holdings Limited, CRE. So this was cheap, another one that was cheap but with complexities. And finally, TI Fluid Systems PLC, ticker TIFS. So this was complex again, but pretty damn cheap on 2019 free cash flow numbers. So yeah, I'll continue to add new additions to this shortlist in the coming weeks. So stay tuned for that. But yeah, there's some interesting ideas already. So it just shows you the value potentially of just going through and really just looking through them one by one, because some things you try and do is just a screener on some valuation multiple or things like that or whatever, and you end up filtering out companies that are going through some complicated situation like that. It's like, for instance, Aviva. I mean, depending on what kind of metric you did, but if you did it on some kind of earnings basis, it looks quite expensive on IFRS sort of earnings, but that's just a function of movements in the market value of their assets and stuff like that, which doesn't really translate to their operations at all. And what's interesting as well from that point of view is, I mean, because unlike banks where there's the whole situation of they've got these marketable securities that fluctuate prices in the markets, but they also have a deposit base that can flee, and then they have to mark those assets to market. With an insurance company, it's not really something you have to worry about, because particularly life insurance, where they're matching them effectively to the duration of people's pensions and so on, as long as there aren't really dramatic movements in life expectancy, which across the whole, a big insurer like Aviva, for instance, it averages out, and they can be pretty damn certain what it's going to be on average across their portfolio. For a lot of these different things, it makes it an interesting. It makes it a situation where they're pretty predictable, and the assets they've got in place will cover those things, and it just means that prices going, interest rates or whatever going up, the returns on securities going up, ends up being a positive for the future, because it means they can get a much better return on the future insurance contracts and so on they write, and future annuities and what have you they issue. And it still doesn't really affect the past ones, because they've structured it to so the duration of the bonds or whatever matches the duration of the annuities or whatever the kind of insurance claims or contracts they have in place. Yeah, and just to mention that Conduit Holdings Limited, I believe, was another insurer which caught my eye. It's quite interesting, fairly newly listed, but it did seem to be a pretty interesting one to have a look at. So yeah. But anyway, I think that pretty much wraps it up here. So yeah, you can read the article yourself on firmreturns.com, as I said, and it's just under this weekly updates tab. Yeah, and if you subscribe for free, or entirely for free, to the newsletter, you can turn this one on and get these coming into your inbox directly each week. And again, it'd be great if you want to subscribe to the YouTube channel, so you get these in as well, and give the video a like, see if we can get a little bit of channel growth. That'd be great. And if you listen to the podcast, yeah, I guess I think there's ways to do ratings on various podcast platforms as well, so that would be great. Yeah, and I mean, feel free to share it around as well. It'd be great to have a few people share it on social media or whatever. Anyway, yeah, I'll get back to you with the next episode next week.